that's the opportunity to potentially reward a rally. Welcome to the Comstock channel. I'm Joe Camp, here to talk about trader positions and where we're at. Those hedge funds in focus here. The normal adage is don't fight the funds. Try to go along with that money flow and be on the side of the so-called smart money, which has as of late been buying the grains, no doubt. Now, the trader positions reports have been suspended during the government shutdown, but we do have estimates that we pull from traders and brokers, like we can see here. This table showing these surveys on a daily basis, rounded roughly to the nearest 500 contracts. You can see the pluses on days where these commodity trading funds were net buyers and the minuses when they were sellers, and more pluses for the corn, the soybeans, the wheat, and the soy products over this last month. That's been the case since the last month and a half worth of a government shutdown and the suspension of these reports. We came in on the corn position with the funds net short just under 100,000 contracts. For the soybeans, it was just short of 30,000 contracts net short. Now, since we've had this buying, we're going to take an update on these charts and talk about where these numbers might be accurate, where they could be off a little bit, and what's next for these positions and what to do about it. Ultimately on corn, again, coming in a net short of just short of 100,000 contracts. You've got that by these estimates whittled down to still a net short, but a smaller one of approximately 30,000 contracts. Now, I tend to say that's a little bit light on the buying end. Now, we know corn futures have not caught pace with soybeans over the last month and a half, but there has been considerable enough of a shift in sentiment that I think this position is probably closer to net even, if not a little bit net long. We're going to talk about that. Generally speaking, if it's still bearish, maybe fade that position, knowing that we could have, one, starting this week, friendly reactions to the crop report and the yield reductions, or getting past that report, getting these reports on trader positions back. We may start to see a continuation of the normal buying interest that funds display heading into the winter months. For now, though, we see that managed money position with that small net short. What we don't know about either would be the commercial position in red and how that represents the farmers' selling activity throughout harvest this season. We think farmers were generally lighter sellers than normal because of the lower prices, but that can start to change, of course, as the funds are buying to help prices higher. That's certainly been the case now with soybeans, and the conversations that we're having right now are about rewarding this recent rally over the course of this jumping up in the managed money position in blue. You've got that now coming from net short about 30,000 to net long almost 100,000 contracts. Will it continue to build from here, or over the course of this last dollar plus rally for futures, is it now going to run out of steam, in part because we do get that commercial net short growing more aggressively because of farmers catching up on those sales? And again, those are the conversations we're having. The thought, don't fight the funds, maybe turning to, should we fade them? Should we fade the funds? Ultimately, it would be joining along with them, because it would be fading their recent action, their recent buying activity, and instead thinking that they're going to shift position and we're going to want to ride along with them on this soybean side, leveling off the net long and seeing some give back potentially into the rest of the fall. A lot of this, of course, riding on China and whether or not you believe they're going to follow through in a bigger way. I think it could be a bit of both, that in the future they will be returning to the U.S. market for soybeans. In the near term, that we can still be set up for a letdown, more buy the rumor, sell the fact type response after the price action and this change in sentiment we've observed since the government's been shut down and these trader positions reports have not been updated, at least by the estimates, though, of those traders and brokers. Moderate enough net long held in soybeans that now is a decision point. Keep it growing, or as mentioned, do we start to see this rally now fizzle somewhat because traders are, from the fund side, not buying as aggressively as farmers are now selling? The real spark can be into the end of the week for trader positioning decisions. This crop report on Friday, we see the average trade estimates for corn yield coming down to 183.8, almost 3 bushels down from the September update. That would be a large move historically, but it was also, a large variance coming into the season with that lofty number to start in August and everything. After that, the shift in weather, the harvest results that we've now missed out on reporting again because these crop reports have not been coming out due to the government shutdown. This is going to be a key, as always, influence for what the funds are going to be doing right away with this position. It's going to say a lot about the technical follow through or not on these nascent rebounds that we've had in corn and soybean futures, but it also potentially sets us up for a letdown. Again, if you're more aggressively expecting the corn yield to go lower, don't count on the USDA, right? We know that was the case last year. It had to wait for an unprecedented cut in January for that corn yield to reflect reality. And soybeans 53.1 down less than a half a bushel an acre. It seems pretty reasonable. I could be under that, but also, again, knowing the track record of the USDA, find that if we're stronger coming in price-wise to a report like this, we can have more setup for failure on price action following. And that's why, again, we're having these conversations with our producers about where markets have been moving since the government shutdown. Now that there's an end in sight for the government shutdown, and we're going to have not only the crop report, which would have came out anyway this Friday, but beyond this, the resumption of those trader positions reports to let us know what the funds are doing, what the farmers are positioned like, and the export sales reports as well. That's another form of buying that's been in the dark during the government shutdown. We could easily come in and say, well, fade the move on funds and their corn position if it's still short, because we can get past this crop report and then get our focus back onto how we're using these crops. And for corn, exports outstanding during this window by all accounts. And to catch up on that data and to see a huge jump in the recent export sales activity is eventually going to be a potential driver higher for corn prices. Yet the deviation that we've had, the relative strength for soybeans, that's the opportunity to potentially reward a rally. That brings up this conversation of not necessarily being careful not to fight the funds, but should we be questioning whether it's time to fade at least their action to this point? For this answer, when the reports start flowing again, we're going to have an update on these numbers, and we'll show you that. Ask you to visit us again at the Comstock channel for another update or to check in on the Comstock report. For now, I've been Joe Camp.
Futures trading involves risk. The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.